All right, Nathan, we can see the screen. All right, just 1 second. Nathan's just kind of getting his projection set up, and then he'll come on here to do the audio. There we go. Okay, perfect. That looks good. And Nathan should just be able to click through on the mic icon in the bottom left. You guys enjoying today's session so far? So we had a couple of speed bumps earlier, but it looks like things are going better. All right, here's a look at the schedule for today.
All right, guys, it's telling me that I have audio now. Can everyone hear me? Okay, great. Sorry about that. Had a little delay there. My apologies. All right, guys. Well, welcome to the presentation. Today, I'm going to be talking about a different approach to the Forex market. And so, yes, Winners Edge Trading, we are Forex educators. And you may or may not be a Forex trader, but I still think that this lesson is going to have some valid resources for you. Okay, I'm getting some feedback that the sound has an echo.
Yeah, just try to turn the volume down a touch. It should help. If you put the mouse over the mic icon, you should be able to adjust it.
All right, is that any better then? All right, we'll go ahead and try with that then. Yeah, guys, I actually do apologize. We just moved into a new office, and I'm realizing that there are some sound issues, and so we're working on soundproofing that from the office natural issues. So hopefully that won't be an issue. Okay. All right, guys. Well, I'm going to be teaching a different approach to the Forex market, and I'll kind of explain why it's different in just a minute. But first, let me do a quick introduction, not to bore you with the intro. But I am Nathan Tucci. I'm only 22 years old, so I can't brag about 20 or 30 years of experience in trading like some of these other guys, who I respect tremendously. So I'm kind of coming to you from a little bit different approach. But I was added to the Winners Edge team a little while ago, about 3 years ago. Some of the things that I do as far as my job with Winners Edge, I do a daily technical analysis, an end-of-day analysis video every single trading day of the week, where I cover the currency markets and just go over the different major currency pairs there. And so that is one of my jobs there. I also run our mentoring program. We have a pretty intensive mentoring program, which I head up. Some of my students may be in here today, I'm not sure. So that's another thing that I do. Also, I do trade our corporate account, which is another perk to being involved on the Winners Edge team, that I get to do that. So that is just a bit about me. And so in today's agenda, I'm going to try to explain how this strategy works. Again, it's a little bit different than what I'm used to teaching on. I'm going to give you kind of the why about why it works, how you can use it. I'd like to answer any questions that you have. And then I'll give you my little mini pitch today, because that's one of the things we get to do, is do a little trial offer. So if any of you guys are interested in that, I'll give you the mini version of that at the end of the training. Okay, not that that has any real value, because the value here is training, but we will touch on that at the end. Okay, so why the strategy is different? And basically, the reason it's different is that our team's strategies are more normal methods. You know, we talk about trend continuation, breakouts, reversal patterns, those kind of things. And so they're more normal methods than what I'm going to be going over today. I just noticed that my region is not quite big enough there, so let me actually just drag that a little bit farther down. But what we're typically focusing on is technical analysis and the things that are considered more normal trading strategies. But today we're going to get into something that is a little bit different than what we typically focus on, and it's going to be something that's less about technical setups and actually more about taking advantage of market conditions. Okay, so now I want to give you guys a disclosure before I get going into this, because there's no way to trick the market. And anyone who's telling you that is either not being honest with you, or they're just confused themselves. From being in this business, I actually get offended almost every single day because of the things that I receive in my email or receive from other people about, you know, tricking the markets and doubling your account in 2 hours and all that kind of stuff. So I want to quickly wipe that, you know, out of the front of your mind and let you know that this is not some trick or some scheme that, you know, I'm acting as if we can, you know, trick a 4 trillion market by some little secret that, you know, we're just so much better than the market and we can double our account every day. But there are some things you can do to set yourself up for success and put the odds a little more in your favor than the average trader who is, you know, just trying to follow technical signals. You hear the stats all the time, specifically about Forex trading, you know, about 95 or 96% of traders who are losing money on a consistent basis. And typically the reason is because they don't have, you know, either they don't have a full trading plan, they only have some kind of entry strategy, and they don't understand risk management and money management and account management, or they just have terrible execution. They have a strategy right in front of their face that could work, but they just don't know how to execute it properly. Okay, so we're going to be discussing one way that can give you an advantage over just your typical following signals. Now, we call this quiet time trading, and if you're familiar with Forex, you might already be familiar with this idea, but quiet time trading happens from about 5 p.m. Eastern to about 2 a.m. Eastern when the London session gets going. And so this is what we call quiet time trading, because there's not a lot of volume, there's not a lot of movement. It's a very quiet time in the market. And one of the big benefits, of course, if you're going to trade in this market, is that, you know, typically the huge institutions are not going to be messing with the market. They're not going to be spiking price up hundreds of pips on certain pairs. And it's going to be a little bit easier to get your bearings in the market because there's less volatility, there's even less liquidity, and that creates a more quiet market. And so the most basic strategy in the world is this quiet time trading, because what we're doing is we're trying to take advantage of these consistent ranging markets by simply buying when price goes down and selling when price goes up. And, you know, trading doesn't get more simple than that. You've probably already heard a million times, oh, sell the highs, buy the lows. Unfortunately, that doesn't actually work in real market conditions. That causes you to lose all your money. But in quiet time trading, there's actually some truth to that, and it can be done. And so what we're going to do is we're going to explore that a little bit today. And rather than, you know, giving you guys trend line breaks and all that, we're going to shake things up. We're going to talk about market conditions and a little bit of a different approach to the Forex market. Now, the first thing to understand about the quiet time trading is that not all pairs are created equal. For this strategy, we only trade 2 pairs: the the EuroCAD and the Pound CAD. And why do we trade them? Simply because they work the best. Not because we like them, not because they have the best spreads. It's because these pairs in quiet time trading are the most effective pairs to trade. Now, the main reason is because it is, you know, basically during the Asian session that we're using this strategy. So because the euro and the pound are not traded during the Asia session very highly, and certainly the CAD is not traded very highly. These crosses have a little more advantage than if you were trying to trade like the yen or something. And the reason the US dollar, even though it's not traded as heavily in that session, is not used is because the US dollar is always heavily traded. So because the US dollar is the most traded currency, it still has a lot more volume than pairs like the Euro CAD and the Pound CAD. So when doing our modeling, Linda talked about modeling, when doing our testing, when looking through this, we simply found the best pairs to use in these market conditions, and those are the Euro CAD and the Pound CAD. Okay, so when looking at the market conditions, you're going to pretty quickly see two things. The first thing is you're going to see why it's called quiet time. It's going to be pretty obvious. And then the second thing that you're going to see is how we can take advantage of that quiet time. Okay, so let me move to the charts now. Go ahead and pull up my charts. And I do apologize. I'm using MT4, and sometimes the charts can bounce around a little bit. And so when you're moving through back and forth, just bear with me, and I'll make sense of that. Okay, so for now, let me know if you can see my chart. Oh, I lost my region. Okay, you should see my chart now. Okay, so what I've done is I've actually just used the EuroCAD as our example. EuroCAD or PoundCAD would be fine, but I use EuroCAD, and I've highlighted all of the quiet time for the month of April. You could go back and do it for years, but quite frankly, I was not willing to go do manual lines for years, so I just did this month. And so what I'm going to do, I'm just going to scroll back through this chart, and you can see all of the areas that are highlighted in green are our quiet time compared to the other market conditions, which are going to be in the white in between those. And hopefully you guys are seeing a pretty obvious reason why this is quiet time. Okay, just put a yes in the box if you're understanding why these green zones are considered the quiet time compared to the other market conditions that you're seeing. Okay, a few more days here, and I'll just go through these quickly. Here's non-quiet time, right? And then right before that and right after that. Pretty amazing. Everyone see that? Let me scroll over just a bit so you can all see that. Quiet time, in between quiet times we have this, and then right after, as soon as quiet time starts, we have this. So this is pretty amazing. I'm showing you this on a 15-minute chart, guys, but this is just 5 p.m. to 2 a.m. It wouldn't matter what time frame you're on because it's legitimate times, but I happen to be showing it to you on a 15-minute chart. Okay, so let me just finish scrolling through the rest of these real quick. And this is April 1st. Okay, so we basically just went through the entire month of quiet time trading. You guys hopefully can see, again, why that's quiet time. Okay, so let's go back to the slideshow, and then we'll get back to these charts in just a minute. Okay, so you saw why it's quiet time. Now, what we notice is that price floats very consistently, during this time in the market. About 75% of quiet time in the Forex market on EuroCAD and PoundCAD, quiet time ends within just a few pips of where it opens. So if you mark where it opens at that 5 p.m., at 2 p.m. when it's closing, 75% of the time it's within just a few pips. Okay, so because of that consistency, we've developed a very basic strategy to take advantage of that. Okay, so you can do a lot of things in trading, specifically in currency trading. I mean, there is a million different ways to approach the market. There's a million different ways to do your technical analysis. There's a million different ways to develop strategies, and I've seen people do them all million, and I've seen people make money in all million. But this is one that makes the idea a lot more simple because you're using market conditions rather than having to take into account, Bollinger Bands and trends and Fibonacci's and zones and wedges and flags and Gartleys and head and shoulders. Instead of looking at all those things and trying to develop an idea of where the market's going to go based on that technical analysis, what we're doing is just simply using the market conditions for a certain time to help us navigate trading. Okay, so here's the strategy. You mark the open price with the quiet time. That's 5 p.m. Eastern or 5 p.m. New York time. That's when our day ends. You put a short pending order 15 pips above that open price, and you put a long pending order 15 pips below that open price. Okay, both of those are going to have a 12 pip stop loss and a 10 pip target, so slightly below a 1-to-1 risk to reward ratio. How many of you guys are familiar with risk to reward? Everyone familiar with risk to reward ratio and what that means? Okay, good. So typically the strategies that I'm teaching, especially, I do a mentor program, the strategies I'm teaching are 1 to 2, 1 to 3, 1 to 4, even 1 to 10 risk to reward ratios. However, this is why this is so different. It's just such a different strategy. Exactly, Doug. That's typically the strategies that we're using. But this is a very different approach, and that's what I mean. This is not an approach that you'll typically see Winner's Edge teach. But it's something that we've been focusing on, and I'll kind of get into that a little bit later, but it's very consistent. Now, as soon as an order is taken on one side, if it's a long order that's taken, you cancel the other order. That way, you're not going to be in both orders at the same time, or you're not going to set yourself up for a loss by, when it's heading toward your target, it's actually taking in a bad order. Okay? So, as soon as the order is taken, you cancel the other order. If a trade is still open when the quiet time ends, or neither order is filled, you're closing everything. So either way, at 2 a.m., when the London starts going and markets are ready to move, you're going to close everything. The idea is that you already have hit a take profit and you'll be done with trading at that point, but sometimes that simply won't happen, and you'll either have orders open or you'll have trades open, and at that point, you're going to close everything. Okay? So does everyone understand, before I go back into charts, does everyone understand those 5 steps? Correct, Daryl. You can use those other pairs. However, the consistency, and by the consistency I mean the overall at the end of the day, when you make 1,000 trades using it, is not going to be profitable or not going to be as profitable. Okay, good. So we'll move right back into the charts now. And so what we're going to do here, guys, is we're going to assume that we were trading this. We'll go backwards just to make it easier. And what we're going to do is we're going to mark when the price opens, which is right, the candle on this red line. And then we're going to assume that we put our orders in at that time. So price opened right here. Because it went down, this was our open price. So with 15 pip orders, what we'll do is we'll grab our little measure here to see how 15 pips, and we'll see if it went 15 pips, okay? To the downside, you can see it did not, okay, not right here. To the upside, okay, also did not. By the way, there's a 5th digit on here, so when it's showing you 100 in that middle stat there, that is actually 10, okay? And the middle stat is our pips, just to clarify that, okay? Didn't go 10, didn't go 10, you can see here. Finally, toward the bottom here, we barely went 15. You can see about 16.2 pips. So your short order would have, or your long order would have been triggered because this little tail would have spiked you right into a long trade. And immediately after that, it would have spiked up and taken your 10 pip target because from here to here, where it took your order, up to here is about 14 to 15 pips. Okay, so it would have immediately taken your take profit as soon as it spiked down. Now, not all of them are going to work quite that beautiful, but this is a great example. The first one didn't order until the very end of the session, but as soon as it did, it spiked up. And what you notice is that price ended up coming and falling right back to near where the open is at the end. It actually moved back down, but you can see that it spiked right back up toward the open, which basically gave you a very easy winning trade in that example. Now, for those of you guys who are having trouble, I'm seeing some things about having trouble with the screen size. On mine, it shows the audience view very, very nicely. So maybe you just need to hit the fit to screen, which is what I'm looking at, to get it to show nicely because my audience view, it allows me to see the audience view, and it's actually looking very good for me. Okay, so let's move on to the next one. We'll just go through some examples here. Okay, here's our open price. We're going to get our tape measure again. We'll go down. Okay, definitely did not go down low enough. Right here, we get in just barely 15 pips, guys. See, it just barely 15 pips, about 17 total here. So we took the order right at the top with the 10 pip target. You can see it fell about 16 pips by the end of the session here. And if you didn't quite, maybe the spread was too big or something didn't get you in, it came all the way down here, clearly enough to get you into the trade. And obviously your stop loss, if you're in here, is going to be up here, and you're going to be very safe from this next spike, so this wouldn't get you out. So another winning trade so far, 2 for 2, which is always nice. But that's our next trade, okay? We'll move our line up to our next open, which is right here. Okay, so price opened all the way down here. We'll see that it goes up about 15 pips here. You would have taken a short order, and what happens here, it goes about 30, 31 pips, and takes you right out of that trade with a loss. Okay, so here's what a losing trade looks like. Instead of the market floating up and floating back down, it just kind of floated all the way up, stayed up there, and easily had enough room to stop you out of the trade. Okay, so that's what we call a losing trade, and I'm sure that, like me, many of you do not like those, but understand that they're part of the game. And so the idea of trading successfully is not to not have losers. Anyone who tells you that you shouldn't have losers, again, is someone who's either lying to you or is just very confused about how trading works. Sorry about my Skype bubble there. Or is very confused about how trading works, because the idea of being a successful trader, and if you don't take anything else from me today, at least take this. The idea of being a profitable, successful trader is not having losing trades. It's having a net group of trades that at the end of the day, or the end of the month in this case, that your losers are smaller than your winners. That's simply all there is to being profitable, that your losers are smaller than your winners at the end of a given period of time. So that's what good, successful strategies are all about. In this example, so far we're 2 and 1. We'll keep going here. Go through some more trade examples. Here we had an open, and price came down again about 15 pips here. You would have got in pretty early. Now it dripped all the way down to about 24 pips for 25 pips, but still very safe with your 12 pip stop loss here, or maybe not very safe, but still safe with your 12 pip stop loss. And then you can see it rallied right up again, closing right where the market opened. And of course, this move from down here to up here was a 30 pip move, and easily would have came and taken your target out for you and would have been a successful trade. Okay, here we go. Another open here. We'll see what happens. Comes down about 20 pips, so easily would have taken your order in right in the 15 pip range. Would not have hit your stop, and then obviously spikes right back up. You can see it spikes from here about 48 pips, so clearly more than enough to get into your target. And by the way, I'm discussing Forex trading for those of you who came in late and are asking the question. This is the Forex market between 5 p.m. Eastern Time, or New York time, and 2 a.m. New York time. Okay, let's go ahead and keep scrolling over here. Okay, here's one where the market opened all the way down here. You can see that it spiked up just enough, about 18 pips here, which would have gotten you into your short order. You would have canceled your long at this point. And then it spiked right down about 8 pips or so, which would not have hit your target. So you would have had to wait the whole way. It looked like it might have got there, but you would have had to wait the entire session until, what do you know, at the end of the trade, boom. Comes all the way down, easily enough pips right here to take that 10 pip target that we would have set up just by being patient and waiting to the end of the session. So another great chart. And by the way, I'm showing you this on a 15-minute. It would not matter what time frame you're looking at, because we're using arbitrary things like pip numbers and the actual time of the day. So the time frame actually does not matter whatsoever on this. Okay, it's just about the actual pip and the arbitrary numbers. And I'll show you guys some actual results. We don't have any back testing results. We're not really into back testing. We believe in live testing, real market testing, trading it on live accounts. So I have some live accounts I can show you guys, but not using any back testing results. Okay, just to clarify that. Okay, let's keep going here. Here's another one. Spiked down just about 15 pips, guys. You see this? 15.8 or 16 pips, just barely over 15. And isn't it nice? I mean, you guys can give me some feedback on this, but isn't the nicest thing in the world where a trade takes, your target or your order in this case, and doesn't even come close to your stop loss, doesn't even approach your stop loss before zooming right to your target like this? I mean, there's nothing better to me than when you take a trade and it doesn't even sniff your stop loss. It just zooms right into your target, and your account just, is instantly a few dollars larger, rather than ever having that worry of being down on the trade. I mean, I just love that. And that will happen pretty regularly on a strategy like this, because oftentimes it's just going barely to that 15 or 16 pip mark to get you into the order, and then floating right back the other way to get your profit. Okay, so we're using EuroCAD, and PoundCAD. Okay, so those are the pairs we're using, EuroCAD and PoundCAD. Okay, we'll keep going through some examples here. Here's another one. Okay, we open down here, not quite enough there, only 8 pips. Here, not quite enough either. About 13 pips here, not enough either here. So this would have been a no trade. Neither order would have gotten hit. Okay, sorry, I didn't move my line there, but neither order would have gotten hit on this quiet time. So you simply would have closed your orders when the time came to an end, and you would have not been around for when this happened. Okay, and the reason we're not trading the typical market is because we don't want to deal with moves like this. We want to deal with nice quiet time moves that increase our profitability by stacking the odds in our favor. That 75% of the time, the market is going to float right back to where it opened. Okay, let's go to our next example. We'll just keep churning along here. Okay, now here's a tough one. Ready? Market opened all the way down here and spiked 55 pips without ever even making a hint toward coming back, and then finally came back. So our order would have been taken in right in this area. Our 12 pip stop loss would have been absolutely crushed, absolutely hammered during that time. And so I think that's our second loser through about, what, 8 or 9 days? So not bad, not bad. Okay, here's another one that was interesting, okay? We have the open all the way down here. See where price open all the way down here? And so this spike right up here would have easily got you into a trade. It's about a 25 pip spike. Your entry would have been in this area, a little bit lower. And so you would have got in here. Your 10 pip target would have had to wait all the way till down here for it to hit your target. So you would have got in immediately, and then you would have waited about 6 hours before you hit your target, which is unfortunate. But hey, you know, profit is profit, and I certainly wouldn't mind it. Okay, now this is the example I showed you earlier. Look how the market moves when it's not in the quiet time. This is what you get. But quiet time, as soon as this market condition ends, quiet time is nice and quiet, and right before it, quiet time is nice and quiet, which is why we like trading this market. Okay, so it's just a floating time. The reason it's floating here, guys, is because most people are not making trades here. They're making buys down here, and they're waiting for the market to take their buy into their target when the real market, when the London starts going. They're not really concerned about this time. There might be some take profits here, but very minimal. There's very low volume, very low liquidity, and so the market's just floating. It's a very consistent floating method that you can see. Okay, and again, these shaded boxes are from 5 p.m. to 2 a.m. New York time during the EuroCAD, or excuse me, for the EuroCAD and the PoundCAD, so the quiet time for those two currency pairs. All right, let's just do a few more here. I don't want to bore you guys with going through 1,000 of them. But here you can see that it moved about 9 pips here. It's floating. It finally would have actually taken your order right in here at the end. You see it didn't move quite enough, and then it would have bumped right back up, and the market would have expired probably with a 2 or 3 pip losing trade. I mean, a very, very small loss here if you even got into the order. So very quiet there. Here's another example where patience would have paid off, because you can see that the market is opening right here. Okay. Finally, at this point, it goes just enough to take in your order. But look, the next bar takes you right into a profitable trade, because you get in here, and this next bar covers about 16 pips. So boom, boom. One bar into your order, the next bar into your target. Nothing better than that. And yes, 5 p.m. to 2 a.m. Eastern time, which is New York time. All right, we'll just do a few more here. Market's opening here. Obviously does not go high enough here. Goes down to your 15 pip range right in here. So you would have got in here. You can see that it does not go high enough. Okay, right? Not go high enough. It does not go low enough to hit your stop loss either. So you would have expired again with a small losing trade here. Okay, so a small losing trade. So far we've only had 2 full losers. We've gone through about 12 days that I've seen. Here's a nice one, so I'll cover this one just for bragging's sake. But you can see the market opens here. Obviously does not go far enough here. Jumps up to right about 16, 17 pips. Easily would have been taken in the trade, and it crashes right through your target. Okay, so a beautiful entry here. Oh, and I just got another nice one here, so I got to show you this one too. Sorry, I gotta show you this one too. Look at this. Spikes right up to 15 pips on the first 2 bars. Spikes right down into your target on the 4th and 5th bar. Okay, how easy is it? Now, fortunately, this market condition was ugly, but you didn't get into it because you were already in a trade and out with your target before it moved these long distances. Okay, guys, so are you seeing the benefit to using market conditions in this example rather than using price action, or, you know, the candlesticks would be price action, but trend lines, Fibonacci's levels? Are you understanding why the market conditions here is actually what's creating a profitable trading environment? Okay, it's very It's very basic. What you're doing is you're looking for an order where the market just swings up 15, at least a minimum of 15 pips, grabs your order, and comes down into your take profit. And it happens very high percentage of the time. And we've actually made some more complex adaptations to hit a higher percentage of the time, but quite frankly, I don't have near enough time to get into those little tiny things that end up changing, and just moving that winning percentage up. The idea of this strategy is for people who are looking for a strategy that increases their account almost every day. There's a lot of strategies that are very profitable, but you can have benders where you lose for a week, you lose for 2 weeks, you lose for a month, you lose for 2 months, right? Okay, those happen. And really profitable strategies, those still happen. But this is a strategy that's really designed to help you win almost every single day because of the high probability nature. And that's one of the things that we work on developing. Kind of one of the tools missing in our basket, so to speak. We're typically using strategies that have very high risk to reward ratios. We're going for 10 times our initial risk. We're being patient. Sometimes we'll add to the trade. It's taking a long time for you to hit your eventual profit in most of our strategies. But this is a strategy that's a lot more simple, a lot more high frequency and high probability, and it allows you to put a tool in your basket that'll help you make a gain on your account almost every single time. Okay, guys, so that's the chart method. Just one more brief recap. These are Forex trading pairs. They're Euro-Canadian, the Euro versus the Canadian dollar, and the Great British Pound versus the Canadian dollar. These are the only two pairs we're trading, and we're trading during the quiet time because it's developing market conditions that will help us hit a high frequency amount of trades. Okay, guys, so that's the strategy. It's very basic, and I'll actually jump back to the slideshow here, and we will. Well, maybe I can just minimize this. There we go. And we'll go over the 5 rules again. You mark where the open price is. You put a short pending order 15 pips above, a long pending order 15 pips below. Both of those orders will have a 12 pip stop and a 10 pip target, slightly under 1-to-1. As soon as the order is taken, you cancel the other order. And if a trade is still open or orders are still open when the quiet time expires at 2 a.m. Eastern time, you close everything. Okay, so that's what we were just showing you on the charts. I was giving you examples of that. Now, over time, if you do that 75, you're going to see how the pips work out. Okay, 25 losers over 100 trades is going to be a 300 pip loss. 75 winners at 10 pips, if you're winning 75%, is going to be 750 pips, which is a net of 450 pips over 100 trades. Now, that's assuming that we're not really taking into account the small losers or the small winners due to expirations. Those don't happen a whole lot, but we're not taking those to account. And we're also assuming with this that you executed the strategy perfectly, that you had absolutely perfect execution of the strategy. And that is typically not going to be the case. Now, again, just to clarify, because I'm getting questions about the pairs, it will work to an extent on other pairs. It can work on other pairs. Other pairs do have quiet time, but simply not as good as the EuroCAD and the PoundCAD. Okay, guys, so this is our little example, our little math, if you're trading with perfect execution. But I don't want to tell you guys that you can trade this with perfect execution because I would be a liar, and I don't like being a liar. So I have to tell you that there are some cons. Number one, the spread can get bad during the quiet time, especially on some pairs that are not quite as major like EuroCAD and PoundCAD. That spread can jump up. It can get up to 5, 6, 7 pips. Okay, so you have to worry about that. That's a big factor. The spread in Forex is your biggest enemy. Okay, if I could kill spreads, I would murder them for all Forex traders across the world because I hate them. And in quiet time, they can be bad. Now, the second con is that it's simply extremely difficult to execute any strategy, let alone one that's all about timing and arbitrary numbers like this. Any strategy that's all about timing, marking your open, canceling your order when another order is taken, is going to be really difficult to execute with any kind of perfection or close to perfection. Now, another big con to this is that the broker can and will spike the bid or ask price to stop you out of the trade, even if price has not quite gone there. Okay, how many of you guys have experienced that? So let me give you an example. Okay, here's your order, right? You have your sell order here, and your stop loss on your sell is up here, right? Can everyone see my black line and my red line? Everyone see my lines here? Okay, good. Now what can happen, and it's very frustrating, is that the market can do this. It can go up, and just took your sell order in, right? It goes up, makes a base near this area, and then it spikes right down into your target. The only problem is that during this time right here where it's close to this, even though the real price, the price you see on your charts, didn't go above your stop loss, the broker can spike your stop above this level, and they can take your stop out. That can very reasonably happen. And it doesn't, we have a really good broker, so for us it's much less of a concern than it is for other people. We use a broker called Institutional Liquidity, so it's really not as big of an issue, but still, brokers make money. Brokers are a business, and you have to understand that. To get mad at a broker for making money off your trading, it's kind of silly because they're there as a business. You join with them, and they're a business who wants to make money. And so they can and will do that. It's part of life. How can they do it, Jerome? Because there's two different prices. There's a bid price and an ask price. And so if your chart's showing the bid price, which is the candlestick chart, they can spike that ask price right above your stop loss, which will take you out of the trade. Okay, so now the cons here, oh, by the way, you have to sit in front of your computer basically the entire session, which is also a little bit brutal, and so that's another con. Now the cons here, they kind of lead into my little mini pitch for you guys today, and I'm running out of time, so I want to just quickly go through this real quick. Hopefully I've demonstrated the potential of the quiet time strategy. I think it's obvious that there's a lot of potential here. The issue, which is often the case, is the execution. And so my pitch to you today is actually to take what I've showed you today, understand the potential there, but let us trade the strategy instead of you trading it for your own. Okay, so that's my pitch, to let us trade for you rather than trading yourself, because we've done this effectively, we've done it profitably, and we know we can do it. And of course, we can make money as a business and as a multiple stream of income besides our trading if we allow people to join with us. And so that's exactly why we do it. Here's how it works. We have a copying network through our broker, which is IOQ, Institutional Liquidity is their name. They allow traders to copy our trades without setting up any software or needing to keep your computer on. So you can actually copy our trade just by joining through their network, and they'll send you our trades automatically. And when you're connected to our network, you're going to receive trades with proportionate trade size based on your account balance. So of course, it'll be based on your balance, and the gains in your account are mirrored identically into your account. So whatever we make, you guys do make. Unlike some software that has slippage and things like that, the network actually does mirror the gains identically to your account as what we make on our account. Just to give you an idea of our track record over the last 2 years, this is what it is. This is making just over 8% a month, which is around our target. Our target is actually 5 to 7%. This is a little bit better. It's actually not ILQ, so we have not always traded with ILQ, but this is a track record for 2 years that's not with ILQ. And then recently moved it over to our corporate account with ILQ just a little over a month ago. And these are very recent stats. You can see March 12th to today, or yesterday technically because the market closed. So just a little over a month. And this is the stats since we moved it over to our corporate account with ILQ. And this is actually the account that we let you copy if you guys want to take advantage of our little pitch, our little trial today. The trial works like this. You have a live trial because we don't do the demo thing. I think I talked about that earlier. We're not into the demo. But you can either get our account info for one of our live accounts. We'll just send you our live account info so that you can log in. Or you can open your own live account to try it. Either one. It's totally up to you. However you want to tackle it, you can take the trial. We're going to give you a 1 month trial to Quiet Time Trader for $10. That's the deal. Pretty basic. Our website is winnersedgetrading.com. And the special trial page is right there. QTT, that's just for Quiet Time Trial, /TradingPub for this special TradingPub offer. And yes, I have a little note there. Yes, we'll refund your $10 if it doesn't make money for you. Okay, so that's my little pitch today, guys. I hope you'll try it out. I think I showed you some pretty good potential there, and certainly we are doing really well with it. So we'd love for you to hook up your account, copy our trades, and see what you think. Yeah, we don't do back testing. These are actually live accounts. Let me go back to that. You can see it says live right here, real US dollar, verified and verified. So yes, absolutely live account. This one's a live account too. I think I cut off the live, but it is absolutely a live account. We don't do any demo accounts. Okay, guys, thank you so much for your attention. I apologize for any little glitches we had with sound or screen or anything like that, but I hope you guys enjoyed it. I hope you're willing to try the different approach or try copying our account. And I wish you guys all the best success in your trading, whether you're trading currencies or not. I think trading is an awesome, incredible career, and I wish you guys all the best in the world. By the way, if you click this page here, we have our support email on there that you can contact us with if you want to do that. Okay, so 10 bucks for 30 days. Give it a try. And I think I'm probably out of time. So I appreciate you guys paying attention.
All right, great. Thank you, Nathan. We really appreciate you being here for sure. Again, yeah, what a great mix of speakers today. I'm really excited about the group of people that we've had and the group of people we have coming up. So again, here's the link to Nathan's trial. I'll type that in one more time. Basically, it's a $10 trial. So I'll type that in. It's in the announcement window as well that you guys can take a look. We're going to give you guys about 1 minute here. Eric is our next speaker, Eric Hale from Options Animal. We're really excited. This is the first time that Eric's actually joined us. I was talking to him last night a little bit about his presentation and some of the things that he's going to cover, and I can tell you that you guys are definitely in for a treat. So we'll give you about a minute break here to, as Jeannie said, grab a cup of tea or walk around, and Eric will be back in 1 minute.
Hey, can I just get a mic check? Looks like I'm moving. Excellent. Okay, so we'll give it a minute and we'll get rolling. Can you see my screen? Do you guys get full screen on the understanding volatility? Does that look good? Okay, excellent. So we'll give it a minute. I've got 12:16 on my computer. We'll give it till 12:17 and then we'll get going. Alrighty, well, I think I'm going to get going. So you guys can see my full screen. I got 12:17. Gave you a minute time to get up to speed. My name's Eric Hale. I'm very pleased, happy to be here. I appreciate the honor, the opportunity to take some time to speak with you. I'm going to talk to you about a topic that's very popular. I'm going to talk about volatility. I have to warn you ahead of time. We are going to move at a very fast pace here. I was actually even 15 minutes before this presentation cutting slides. There's a lot that I want to teach you. There's a lot to learn here. It's a very exciting topic. There's a lot of intricacies and things you need to know before you go out and trade in this market here. But there's a lot of potential to make money, and that's what we teach you to do at Options Animal, is how to make money, mostly around options. So, with that, let me get going. I need to begin actually with our standard disclaimer and state that all rights are reserved and copyrighted to Options Animal, and the content of this presentation is not considered a recommendation or